All right, so this lesson is going to be on stop runs, right? The day is 6/11/2021. All right, so stop runs. Stop runs have everything to do with liquidity. Okay, so we have to have a solid grasp on what liquidity is. What is liquidity? One more time. I've asked this question a million times, but what is liquidity? Can anybody tell me what it is? Like exactly what it is? It's money, stop losses, margin calls, money, pools of money or stop losses, money, order flows, money footing in the market. Right, exactly. So a lot of you guys are giving some varied answers, and I'm going to tell you exactly like how, like what the market consists of in terms of liquidity. So it's essentially money, right? But money includes margin calls, orders, stop losses, um, buy stops slash sell stops, or limit orders of any kind, which can be triggered and stopped out soon. Well, just stopped out. We'll just put it that way. Okay. So it's essentially, it is money, right? But what it makes up is orders, right? So when we say the word stop run, what can we essentially conclude that stop runs are? At the end of the day, stop runs will end up being, they will end up being times that price, runs up to your stop loss and takes it out. So how many times have you guys seen price do something like this? Let's say, for example, let's say you see a downtrend on the market, right? It's providing a lower low, good and all, right? But then it creates an equal high, goes a little bit lower, and then it comes back up to it. Now, when it comes back up to it, a lot of people would be inclined to say, "Oh, well, this is an order block," right? Even people who are trading smart money, they would be inclined to say, "Oh, this is an order block," right? Or, "Okay, I'm going to fib from my 79% entry right here," right? How many of you guys would do this? How many of you guys would go for that 79% entry, or for that quote unquote order block? Right. So there is actually a break of structure, right? Right here, the break of structure is right here. It did break structure. So it technically fits all of our criteria, right? Technically. But what piece of criteria do you think it doesn't fit? What piece of criteria does not fit? What piece of criteria does not fit? There's what above the high? Liquidity above the high. Exactly, right? So in this case, liquidity, think about it this way. I want you guys to think about it like this. Where could stop losses be? Let's say you're trading retail, right? And you're trading this like a trend line. Where would your stop loss be? Let's say, for example, price was coming back up here from all the way up there. Where would your trend line be? Obviously, your trend line would be something like this, right? So where would their stop losses be? Above this high, right? Above this high, there would be a lot of stop losses, right? So from the previous move and from this move, there's going to be a lot of people who have sold it. There's going to be a lot of people who have sold it. So what are we going to end up doing? Well, back here, we can essentially say that there's a lot of liquidity. Why is there a lot of liquidity? Because as we said earlier, there are stops back there. Stop losses are right here. Stop losses are found right above that high. So when price pierces through this high and takes out the liquidity, what can we expect? What do you guys think is going to happen to all of those orders? What's going to happen to all their orders? Right, they're going to go into massive drawdown or they're going to get stopped out. Exactly. So when they get stopped out, this is a stop hunt. Like this. This is a stop hunt. Okay. Now, do you see here? Do you see here how price went through the high, took out the liquidity at the top? Now, what do you think will happen? Price has taken out these stops. Now, a lot of retail traders, what do you think they're going to do when they see it pierce this high? What do you think a lot of traders are going to do? Think back to your retail days. Think back to when you used to trade with this stuff. What would happen? What would you think of? You think of a buy, right? A lot of people would think of a buy. Well, why would they think of a buy? Oh, this is a break and retest. Like some very famous traders out there on InstaScam, right? What's gonna happen right here? See, like, oh, when it comes back here, you say, oh, break and retest. Okay, so now it retests, and now we'll buy, right? A lot of people would buy here, or people would just panic buy because they're like, oh, it's already up 30 pips. Let me buy. Man, you're about 30 pips late. Or how many people do you know that trade like this that have a buy stop at the top right here? So that once it crosses, it'll put them into a buy. How many people do you guys know that do that? Quite a bit, right? Quite a bit of people do that. That being said, when price does this, why do you think that type of trading? So let me ask you this question. Why do you think that type of trading is so common? Why do you think this type of trading is so common? Why do you think about it? But why do you think it's so common? Who do you think first leaked it? So all these patterns, all these indicators, break and retest, all these other things. Who do you guys think leaked it? Right, exactly. Big banks know that happens, but they know it's not consistent. They paint it on purpose. So if we think about it like that, now we understand why this happens so consistently. Because literally all they have to do is keep cycling, keep cycling, keep cycling, keep cycling, keep cycling the market until people just keep getting stopped out and stopped out and stopped out and stopped out and stopped out, and they finally get out of the market. Now it also creates, an addiction for a lot of people because a lot of people just like to throw money at it when they don't understand what's going on. Now, when we understand that now stop hunts have continued through there, where do you guys think we're going? Where do you guys think liquidity is going? Do you guys think it's going to continue up? Do you guys think it's going to continue down? Where do you guys think it's going? Down, down. Okay. Well, we know that's the right answer, right? We know that it is going to go down, but we have to know why. Why is the trade going to go lower? Why is it going to target these lows? Why? What is down here? And don't just say liquidity. It's a type of liquidity. What's going on here? What is this? What can be found here? The directional premise, right? But we don't want to really talk about directional premise. Orders, pivot points, stop losses. Exactly, stop losses. Right. What's down here? It's sell side liquidity. So think about it this way. Once price came up, right? Once price came down, stop losses were all the way here, right? Why were stop losses all throughout this region? People selling late, people panic selling, people, doing stuff like that. Now, people that caught the buy all the way up here, where are their stop losses? Their stop losses are back here, right? Their stop losses are back here because they want to stay safe. Now, what is also here? What is also here? It's not just stop losses. It's also people that want to enter new orders. Now, what kind of order would that be? So we can even write that down, right? So it's going to be buyers, SL, and what else? Sell stops. Okay, so here's the buyer stop loss and the sell stops. Now, right there, right, a lot of people, what they're going to do is another very common form of retail trading is like this. People end up taking this setup, right? They end up buying it. Cool. They reach their target, or they keep holding because they want to break out. Now, price retraces into its internal liquidity, and then from there takes out all of their early positions or puts them in drawdown. After reaching below this low, it stop hunts, right? Basically, it takes out their stops. Now, what a lot of people will do, and what a lot of funds will do, is this: right at this low, to protect their entry, what they're going to do is they're going to put a sell stop. A sell stop is just a pending order, right? That you can predetermine it in the market. And then from there, once price crosses through it, your broker will put you in a sell at the point that you put the limit, or a buy if it's a buy stop, right? So a sell stop and a buy stop. By the way, does everybody understand what a buy stop and a sell stop is? Yeah. Okay. Is there anybody that doesn't know what a buy stop or a sell stop is? Okay. Awesome. So now that we understand what that is, let's talk about it in this sense, right? People come, like, so banks come for all this liquidity down here. Now that they've taken these buyer sell stop losses and the sell stop, where do you guys think is the other piece of liquidity? Right? Because banks are always going to want to go for sell stops and buy stops. They're always going to want to go for that. Okay. Well, let's do it like this. For think about it like a homing missile, right? So, for example, think about it like a homing missile. A missile, right, from the U.S. Let's put it this way: right? A missile from the U.S. It's a rocket, right? It has a target, and even if that target moves, the rocket's gonna follow it, right? It's gonna go boom until it hits it, right? So the rocket comes down, takes out cell stops. Now, where do you guys think it's going to take next? It already took out cell stops. What's missing? What's missing? Buy stops. Exactly. So now it's going to blast. Now it's going to blast off. And what's it going to take from here? All of this liquidity. Now, what kind of liquidity is found here? Well, very simply, let me put it like this. There's going to be seller stop losses and buy stops. Does that make sense? How there's seller stop losses and buy stops too? Right? So where does price find its sell side liquidity? This is normally what we call sell side liquidity, and this is what we call buy side liquidity. But we can also just shorten it and say like buyer stop loss and seller stop loss, or just say buy stops and sell stops we're taking, right? So like buy stops are up here, sell stops are down here. So we can just say like, sell stop, buy stop, whatever the case may be, right? So does that make sense? Right after it takes out this liquidity, then price can continue however it likes. Right? Price can go down, price can continue on the break of structure, but price has already taken both sides of liquidity. After that, it's up to order flow. Does this make sense? Does this make sense how it happens? Does this make sense? I want to make sure that people understand it. Does anybody have any questions? We can take questions right now. So the process will continue with each trend development. So yeah, this will happen normally. This will happen very often. This will happen extremely often. Almost every day, honestly. You guys can see that in the concept of Asia range, right? Asia range happens every day, and price usually always takes the Judas swing. That's another concept, right? But during the range that forms in Asia, the high and the low is always taken. The high, the low, and then it continues. All right. So how how stop runs move? Okay, so they're not something you're gonna take a trade off of unless it's a Judas swing, which is something you'll learn later. Okay. So is this manipulations and accumulations too? This is a type of manipulation, right? So this happens during accumulation. Sometimes this happens during all of these sections. The only thing that's different about stop runs is that stop runs in themselves, right? Their nature is to take out stop losses, is to have an explosive move to the upside or to the downside, and take out these stop losses so that people will not be in the trade or that people lose the trade, right? The banks want people to lose the trade as much as they can. So what's going to happen? We see the buy stop right here. You guys see it get taken, right? This doesn't just happen here. This happens all the time. Let's look at it on a chart. This happens in every pair, not just one, not just two. Happens in every pair. All right, let me show you right here. We see UJ. Let me actually replay so that you guys can see it. All right. One thing that people have been asking me, how do you determine what range you're in? Okay. Very simple. Look at the break of structure. Look at the break of structure. Where was the break of structure? The break of structure was right here. This was the last impulsive move. Then price retraced down. So this is your high of the range. That's your high. Now, where did it originate from? It originated from right here. Did it create a new low? No. So this is technically going to be the low of the range. But if you're trading on local price action, this would be the low of the range. So there would be a local low and a swing low. Right? This right here is the local low, and this here is the swing low. And the reason why I put it there is because I'm playing off the bottom of this candle right here. The bottom of this candle right there. That's what I'm calling the low, right? So this is, I'm going to change the color for this line. I'm just going to, make it like, I don't know what color to make it. Just make it like red, okay? So this is the local low, and these are the swing lows, okay? So when we think about that, well, all right, where is the buy stops? Where is the sell stops? Right here. I want you guys to tell me. Where are the buy stops? Where are the sell stops? Tell me that. Where are the buy stops? Where are the sell stops? Right, obviously, but what I'm saying is like where on the chart? Where on the chart? Buy stop at break of structure. So at the top of break of structure, right? So it's right here. And where's the sell stops? 110. Buy stops at 109.6. Buy stops at 109.6. All right, 109.6. Right. So no, that's not correct. Um all right, so at 110.16. Right. So buy stops would be right at this high, right at the high of 110, 199. Right? And the sell stops would be right here at this red line, right at 109.3 387. Okay. And the reason why they're there, very simple. I just closed that. I shouldn't have closed that. Okay. This is where the low is going to be held, right? This is where these stops are going to be. Now, why are these stops going to be here? Well, very simple. Let's think about it this way. Let's think about it this way. We see where the buy stops are, because if price were to push through it, where do you think all of retail is going to have their stops? Right here, right? They're going to want to try to catch the breakout. Okay. And right here, even though our swing low is down here, we want to trade our local low, right? Because our local low being right here is going to be what catches our attention, right? This is where a lot of people are going to have their sell stops, because people are going to be like, well, if it breaks through here, it's definitely going to go lower. So I have to put my sell stop right here. That's where a lot of stop losses are going to be too, right? Stop losses are going to be right there because of this move higher. Let's say they bought off of support and resistance, quote unquote. Okay. Well, if they bought off of that quote unquote support and resistance, right? That fake support and resistance, what's going to happen? Well, people are going to buy from here, right? And yeah, it gave them a couple pips. It gave them what? It gave them 50 pips. Cool. They're celebrating. Awesome. But at the same time, people will hold this. They're going to say, "Oh yeah, swing trade." And it's like, "No, it's really not." But, price keeps falling and falling and falling, right? And then price is going to go hit their stop loss. Now let's watch how price acts. The price reaches above it. You guys see how price reaches above these buy stops? Price reaches above these buy stops. And then what happens? Let's watch what happens. Right. So it took the liquidity at the buy stop. Now, do you guys see what happened? Price took the liquidity at the buy stop. And then what happened? Immediately after. Right. So liquidity taken at the buy stops. And then what? Liquidity also came back down and did what? Price. I mean, not liquidity. Price came back where and did what? Then sell stops. Exactly. Right. So what happens is a lot of people in this case, this here, I also want to address a question that I know people are going to ask. Would this have been a valid, form of entry for smart money? It would not have been for me. In this case, sure, you could have, had your fib out, and yeah, it would have probably reached, somewhere near your 779. But in my personal opinion, there's liquidity down here. I would not have taken this. Okay, I would not have taken this. So in this particular example, we see how buy stops were taken, then price immediately came back down and took out these sell stops right here. Right. So now that price has done that, how could we have capitalized on something like this? Well, very simply, it relies on break of structure on lower time frames. So let's say that we came back down and we looked at this move on lower time frames. We saw that buy stops were taken. So what are we expecting? Are we expecting price to continue? Probably not. We're not expecting price to continue. What should retail traders do now in this in this condition? Cry. That's what they should do. Right? But look, what happens is this. Let's go on the 5-minute chart. Let's see what happens. Okay? Price took out these buy stops. So now we're expecting to see a break of structure. Where did we see the break of structure? We saw the break of structure happen right here. Change this back to black. Here we go. Right? Buy stops were taken. And then from here, we expect price to break this low with a full candle close. Right? So price did break this low, full candle close. Now it would have been a little bit risky, right? Because there was no definitive taking of the top right here. So I would have been wary of that. I would have probably cut my risk to 0.5%, right? Not a full percent. But either way, you understand the concept. Now, how would we have taken this entry? How would we have taken this entry? This is up to you guys. How would we have taken this entry? And honestly, I hadn't even looked at this example until like right now. It just popped up. Literally, I didn't even prepare for the example part. Okay. So what entry should we take right here? How should we take this entry? Think back to your entry types. Do you guys remember that? Your entry types? Okay, fib, right? That's one. What about the other? What's the other one you could have used here? Fair value gap? Where was the fair value gap? I don't see a fair value gap. Perfect. So I see a lot of people giving correct answers. I see some people struggling a little bit. So let me give you both of the answers. First answer is a lower time frame order block. Where would the order block have been? Well, it's the last opposite candle, so it would have been right here. Last opposite candle, right? So it would have been this candle right here. Let me point it out. This candle right here. Let me change the color for this because this is low key. Like, all right, there you go. Do you guys see what candle I'm talking about? Let me actually also take off my crosshair. All right. So do you guys see it? That candle. That's the order block. So where are the orders found? At the open of the candle, right? At the open of the order block, at the open of that candle, that's the order block. Okay? At the open of the candle. So where was the open? The open was right here. You guys see it? Price pushes up. So that's going to be your entry, right? Now, when you see that, you short it right at your entry. Now, where would your stop loss have been? Where would your safe stop loss have been? So I'm asking for your safe stop loss, not for your refined stop loss, for your safe stop loss. Right. So your stop loss would have been above this wick. So right at the high. There you go. Right. Now, how would you have determined your take profit? How do you think you would have determined your take profit? Can you determine your take profit on the 5-minute? Can you? No, you cannot. So where would you have gone? To a higher time frame? 15-minute, hour. You would have determined your take profits. You see that there's a lot of internal liquidity right here. Internal liquidity, internal liquidity, internal liquidity. So then you would have said, all right, where's going to be your first take profit? First take profit is going to be right here. Second take profit is going to be right here. And your last take profit, according to the hour, right, according to the hour time frame, would have been where? Your last take profit would have been at this point right here, right at the sell stops, right there. So this would have been your what your trade would have looked like. You could have also just taken this off, and you could have just held until this first take profit held. But from here, you would have taken this all the way below. Now, this is something that I haven't really taught before because honestly, students have a hard time with these. But when it comes down to it, when you have a break of structure, right, on lower time frames and it's targeting something or it's reacting because of something, that's when you should take it. Right? You shouldn't just take it when you just feel like it, right? You shouldn't just take it like looking at the 5-minute waiting for break of structure all the time. That's not a good idea. According to the hour, yes, it can be a fair value gap, but it's not going to be your entry. Right? You're not trying to buy this fair value gap. You're trying to sell it. Right? You're trying to fill it. So yeah, technically you could say these are fair value gaps. Yeah, sure. But you're trying to fill them in. You're not trying to you're not trying to do anything else with them. Right? The TP? No. Well, actually on lower time frames you could have, but for me, I would have targeted those sell stops. And right here, these aren't really fair value gaps. You could say this one, but it's already covered behind right here. So, and these aren't, right? These really aren't. So in my personal opinion, I would have waited until this low got cleared. Right? But on the hour, it's a completely different story. So in this case, right, total, you could have netted realistically about 1 to 15, 1 to 10. Right? So that would have been pretty good. Now let's keep going and see what's up on the bottom. Right, so price goes below. Let's see if there's any break of structure down here. What do we see right here? A very lower time frame order block. Look at that. Look at how you can refine price. So you see how price continues, shows signs of going up, right? Shows signs of going higher. And then what happens? Let's look at the 3-minute. Let's refine a little bit more. And actually, I believe Garrison took this trade. Did anybody take this? Because I believe Garrison sent this out for you guys to take. Did anybody take this? Yeah? You guys, some people took it, right? Great. So why was this trade taken? Well, very simply, there was signs of going higher. Price showed an order block here, right? We had just taken sell stops. So obviously, we can be a little bit more lenient when we already took sell stops because there's no more liquidity. So where are we looking at? We're looking at this right here. Last opposite candles. It's going to be the last bearish one, right? Which is right there. There you go. And now your long position would have been here, which I think this was Garrison's long position. Stop loss behind the wick right here. And then what would have been your take profit? How would you have determined your take profit? Can you determine your take profit on the 3-minute? Higher time frames, exactly. Let's say we would have gone back to the hour. Where would your first take profit have been? Guys, please make sure you're muted and it stays muted, please. Until later on, because some people like to talk at the end, and I don't want to mute everybody and I have the ability to take them off. But so from here, where would your take profit have been? Any guesses? Any suggestions? 109.6. Well, I mean, sure, but what is found there? So for me, this high would have been the first TP, right? That would have been the first take profit. Honestly, probably the only take profit. After that, it's just filling up this void. But filling up that void is going to take a while, right? So probably not intraday. It would probably be daily, right? So actually, price gave you one last entry almost. And then price came up and hit your take profit, right? Pretty cool. Now from there, you would have probably secured, if not your whole position, which in my opinion, considering your risk to reward, I think it would have been good to secure all of your position, right? But if not, you could have allowed yourself to hold some position, right? Hold some partials. Now, apart from that, what could you have taken? Well, there's another order block right here. Price already broke structure. Okay, well, there's another order block right here. Let's see what happens. They would have said, all right, well, I want to take this right here. I want to at least, take out some more liquidity. Let's say you're targeting the high again. For example, that's not much risk to reward, but let's say you want to target this high. Okay. See if price does what we want. Okay, so triggered in. Oh, very nice. And this is where price is now, right? So we see that price actually did take this order block, right? And it shot higher. So this would have been a valid order block. Very nice. Does everybody understand what I mean by how you can take trades with stop hunts? With stop hunts, what you really want to do is you want to focus on your lower time frames, right? You want to master those lower time frames, because if you're not mastering those lower time frames when it comes to stop hunts, it's going to be a lot more difficult for you to get paid when you see these stop hunts, because you won't be able to recognize how you can get your entry. Okay. So with that, I'm going to leave you guys with the homework, right? And the homework is really just find stop hunts. Okay. Find them. So for example, we can find them in Euro USD. Let's say on the here's one. Here's another one. Let's look at this. Price had a low. Price had a high. Price took the high. You guys see how price broke structure, took the high, buy side liquidity. Then what? Price took the low. Okay. So both of these were stop hunts. There was liquidity right here. There was liquidity right here. Both of it was taken. Does that make sense? Actually, let's change the color to something different. I don't want it on black, but I don't want it on green. Green looks weird. Put it on blue. Does everybody see how that works? Does everybody see that? Right, and then from there, how would we have taken an entry on these? Well, look. Look on the 30. Maybe there's something on the 15. What do you know? There is something on the 15. Right, so on the 15, we find this lower time frame order block right here. So we're going to mark it right there. We did suffer some drawdown. Right, the order block is right here. There you go. So that's the order block. And then from there, your first take profit would have been this low. Okay, and from here, you're netting at least a 7% return. That's pretty good. Now you saw that price took out these buy side stop losses, and now you're targeting these sell side stop losses. So you honestly could have taken it all the way down there and netted 21%, right? You could have. You probably didn't, right? You probably secured partials along the way. But at the same time, price did follow your analysis completely correctly because of how you understood stop runs, how you understood liquidity running, right? So this is one of the most important things about liquidity that you're ever going to learn. Okay, stop runs, because price is always going to seek and destroy liquidity. Okay? Think of it like that heat-seeking rocket, right? Just exactly how the military uses heat-seeking rockets. The banks use heat-seeking algorithms, money-seeking algorithms, liquidity-seeking algorithms. Let's put it that way. They use liquidity-seeking algorithms to just seek out liquidity, destroy it, and then move on. Okay? They're brutal. They're brutal and they're efficient. Does this make sense to everybody? Do I have any questions? Do I have any questions at this point? Yeah, you'll find it in your IX Academy app. No, to understand liquidity, I started on higher time frames, then confirmed it on lower time frames. Liquidity will be most useful to you the higher up you go. And remember, if you see an order block and you see buy side liquidity or sell side liquidity beneath it or above it, don't take that order block. That's just a beacon to get even smart money traders into the mix. Previous recordings are available on IX Academy. Yes, correct. I'll answer that in a little bit, Sandeep. All right. Does anybody have any questions about this? No? You relate different candle types, shooting star, inverted hammer, dojis, tweezer tops, bottoms. No, I do not. I don't use types of candles. The only ones that I use are candles that look like order blocks. That's all that I use. Each candle will have a plethora of data that you need to understand, but that's for way later on. Okay, so no, I do not. I don't use those. Order blocks in lower time frames. Okay, have you watched my order block class that I gave? Have you watched it yet? Okay. So in that class, I explain, right? I explain that order blocks on lower time frames most of the time are found, right, at highs in wicks, stuff like that. And they're found like this. They're found oftentimes with a giant body, right, that is impulsive, and then a really like kind of inconclusive close like this. So what you want to do is you want to wait for price to come here, right? You want to wait for price to break structure, which in this case it did. Didn't break it all the way down here, obviously, but it did break it. Then once it broke it, it retraced. Right? You could have taken this entry too. That would have been fine too. But at the same time, price continues up higher. Right now, when it takes this order block, that order block can only be found on these lower time frames. The reason why it can only be found on these lower time frames is because on higher time frames, it'll just look like a wick. It'll look like the end of a candle. That's what it'll look like. So that's why multiple time frame confluence is very important. So what you're looking at here is an entry point that you could have taken. Now you could have also taken another entry. Let's say you're just like, I'm sick of trying to find order blocks. Rah. Okay. Well, here you go. Here's an entry. You could have taken your 79%. Right. It would have retraced a lot deeper to your 88.6. That's fine. Your stop loss is going to be behind the wick. So why are you worried? No, and you're just sacrificing what? A bit of risk to reward? Yeah, you're good. So either way, you could have used either one of those. You could have used your fib or your order block. Either one would have been perfect. Does that make sense to you? Because I'm not sure what exactly you wanted me to explain, but that's kind of like the best explanation I can give you in terms of that. Okay. After a big body, opposite body must have a big wick. No, I never said that. Sometimes it happens. It doesn't always have to happen. Just know that your stop loss has to be somewhere around the wick or at the candle body if you're really confident. But no, it doesn't have to. It just happens often. So that's the lesson for today, guys. I'm going to give you guys some homework, and that homework is find this on your chart naturally. Find this on your chart how you would normally. You guys see how price traded below this low? I had a very big feeling that that's exactly what was going to happen on EU. I just kind of went against my bias and tried to trade something different. So if you look on EU, one last example, we have buy stops that were up here. Buy stops got traded into. Price came down, sought to destroy the liquidity down here. And there's your seek and destroy profile. And then what's down here? The low is found. The low is found right here. Another liquidity pool. And from here, price is going to continue lower. Okay. So that's another example on EU. So find a high, find it getting broken, and then watch how it turns around and seeks the other piece of liquidity. Okay, that's going to be your homework for you guys. All right, and I want you guys to send examples. Okay, I want you guys to send examples. I want you guys to send them. We're gonna make a chat sometime. Just don't know when, but we're gonna make a chat sometime. Okay, cool, good to go. All right, you guys can reach me. Oh, actually, I can't even share my Instagram with you guys anymore. But yeah. So you guys can reach me on Instagram. You guys can reach me through email. Um, anything else that you guys need, I'll be here for you guys. I'm going to try to push to make that free chat or that chat as fast as we can, but I can't rush the boss. So yes, there you go. That's my ID. All right, guys. So thank you guys for coming. I hope this session helped you guys. And yeah, you guys have a good night.